you kind of have to crack up sometimes because people kind of say, "Oh, you're crazy." Inflation's coming back and sub 2%, and the Fed will be able to do this. And I'm like, no, inflation's going to stick around 3%. It's going to get sticky at 3%. And now all of a sudden, Bill Ackman did a tweet last night, one of the big hedge fund managers in the world, by the way, saying that he's buying or he's basically shorting long-term bonds because he expects long-term rates to spike dramatically higher.
Throughout its history, the Federal Reserve has never managed to achieve a soft landing, raising doubts about the likelihood of success this time, especially given the current volatile economic conditions. Gareth Soloway highlights the absence of any soft landings in the past, even when the Fed attempted to navigate economic scenarios with rate hikes. Instances like the recessions in 2000 and 2007 further exemplify this challenge. One of the reasons behind this difficulty is that the Federal Reserve often relies on lagging data, which puts them under pressure to anticipate and address economic issues in advance. However, their recent approach, such as downplaying inflation as transitory, has backfired, leading to overcompensation, a common human tendency when trying to correct past mistakes. This overcorrection has, in some cases, resulted in pushing the economy into recession. Gareth Soloway shares his insights on recent market developments, including Japan's bond buying, increased yields, GDP, and jobless claims.
I want you guys to understand a couple big events that occurred overnight. Number one, Japan did another bond buying program. Now, what's so mind-blowing about this, and we've just come after the debt downgrade by Fitch, where the U.S. debt got downgraded, but we know from last week that Japan basically was saying, hey, listen, inflation is so high, we can't artificially keep rates at essentially zero. We need to let them float up. The problem is this. Check this out. When they started to loosen control of the yield curve, yields began to spike too aggressively. And again, this is what happens, is governments try to control this crap, and when they loosen up, it begins to spike back to where it's intended to be, where market factors are showcasing that it should be. And what we're seeing in Japan is that they have so much debt to GDP, they have so much debt, all these issues plus inflation, is that yields in Japan should be much, much higher. And so to keep yields from spiking too much and just raising them a little bit, Japan is having to do bond buying. And remember, bond buying is essentially flooding the market with money. And this is going back to what the Fed will eventually have to do. The Fed will eventually have to do this as well. They're going to eventually have to print money. Now, Japan's not going back to print unlimited money. They're just trying to control the yield curve. And it's literally like playing with a lit bomb right now. I mean, like if they don't do it right, you can have a blow up, which by the way, the market's starting to tell us. If we look at the VIX spiked yesterday. We know the market sold off, right? There's a debt bomb, and I've said this for a long time, is when you have countries that have debt to GDP where they are, like the US and Japan and much of Europe, this is problematic. This can't go on forever. And when you have inflation, that's when you have trouble. When there's no inflation, you can do it. You can print unlimited. I mean, think about MMG, modern monetary theory, MMT. The idea here was that governments can print unlimited amounts of money. This was somehow believed by economists over the last 10 years, as well as a lot of politicians. And politicians are idiots, frankly, most of them at least. So that's not even a big deal. But the economists, that was always surprising to me. Because how do you think that a government can just print unlimited and there's no repercussions ever? There is. If there's a repercussion for my household, the US or Japan or all of these countries, they are just a bigger household with more individuals under one roof. In fact, let's take a look at the 10-year right now. And the concept here is that the short end is much, much higher, right? So the short end, if we look over here, let's go to the 10-year. The short end yields, the short end interest rates are much, much higher than the long end. And the idea is everyone expected inflation to be high in the short end, which is why interest rates were high in the short end, but to come down later. Well, guess what? Reality is that's not happening, which means the yield on the 30-year, on the 20-year, even on the 10-year is likely going to go up. All right, so again, by the way, the charts told us this, and this is what's amazing about the charts. Even I was kind of like, wait a minute, maybe yields will start to fall. Maybe we'll start to see, the economy weaken and inflation come down more than expected. And then I looked at this chart, and this chart is as clear as day. And when I saw it, I said, no, yields are going to go higher because you have a very clear trend line, and you have a pullback, hit, pullback, hit, pullback, consolidation in a bull flag, breakout, and then a retrace to the scene of the crime. And 9 out of 10 times that happens, when you retrace to the previous resistance, which is now support, you get a breakout. And look at the 10-year, 4.18. Now, the scary thing about this, folks, is that the last time yields popped, if we go back on the 10-year, right, see this high where you had this big pop? You know what happened there? Silicon Valley Bank failed. All these banks failed. So you get credit issues, you get credit crises from big spikes in yields. And we're probably approaching that. Look at this breakout here. Again, the reason why I say this is a breakout is because it's a short-term breakout. If I put a trend line at this high, that was that high. Now we're breaking out. Next target is this point right here, which is the highest point, which, by the way, you want to know something crazy? By the way, this was when yields topped out. It was October of 2022. That's when the stock market bottomed out. So in theory, it tells you how offsides the stock market is and how much risk there is, that in theory, if the 10-year goes back to this point, why isn't the stock market back to October lows, which is down, what, 20-25% from where we are? Just saying.
In the 3 recessions that occurred before the coronavirus pandemic, the U.S. central bank reached its peak interest rate level and began reducing borrowing costs anywhere from 3 to 13 months before the downturn started. This illustrates the challenges of trying to halt an economic decline once it's underway and aligning the slow-moving effects of monetary policy with the economy's future needs, which might be months ahead. One critical concern in central banking is to avoid allowing high inflation to become ingrained in the economy. Fed officials are wary of this and prefer the mistake of being overly cautious to ensure inflation remains controlled, rather than risking its resurgence. Antonio Bonfim, the head of global macro for the Global Fixed Income Team at Northern Trust Asset Management, and a former special advisor to the Fed's Board of Governors, highlights this approach. Now, let's turn our attention to Gareth's insights on jobless claims and GDP growth.
Now, listen, there are some differences, right? I mean, you could argue that inflation isn't as high as 9%. That's true. But again, if we see any sign of, and this is the kicker, any sign of a slowing economy, meaning a potential recession, if that happens, and by the way, jobs numbers have remained strong. ADP yesterday was strong. Jobless claims today stayed low. Everything's looking okay. Jobs report tomorrow is going to be key. But if we see a recession on the horizon and you still have inflation at 3%, watch out, because the markets will react and flush. And by the way, just going back to the 10-year yield spiking, one of the big issues here, guys, is not only that the U.S. has 32.5 trillion in debt, 1 trillion essentially in interest payments, but a lot of companies have debt that's now rolling over, and they're going to be essentially refinancing or redoing that debt at current levels versus 1% what it was. We're now looking at 5-6% type renewal of corporate debt. And that, again, is going to be a huge drain on earnings over the next few years, because there's a huge difference when you have $10 billion in debt, which so many companies do. If you're paying 1% on that debt on a yearly basis or 5 or 6%, think about that. For those of you that have bought a house recently, think about the difference between what you would have paid at a 3% mortgage. Now you're paying 7 to 8%. Huge, huge monthly different payment. So again, storm clouds, and again, flipping back here, guys, storm clouds continue to brew. I've been warning about this. I'm not going to say that this is the beginning of the collapse. I'm not going to say that this is the exact high. We'll find out. What I am telling you is that over the next 6-12 months, things are going to get tricky. And as long as you've been following me, you know that I've been warning about this. And I want you guys, even if you say, screw Gareth, forget it, I'm going to go long the markets, I'm going to go long every big tech stock out there, that's fine. I just want you to have a balanced picture. Because this morning when I turned on CNBC, and again, you guys know, my point of this show is to not be mainstream media, not feed you guys the same crap that they're seeing. What did I hear? Oh, Warren Buffett said, don't worry about the downgrade. Jamie Dimon said, don't worry about the downgrade. No big deal. Don't worry about it. Okay, well, why? Well, let's look at the data. What's the data showing? And the data is showing a insanely different picture. Now, why would Jamie Dimon and why would Warren Buffett say don't worry about it? Well, they don't. Imagine if Warren Buffett came out and said, holy crap, we're screwed. I mean, think about the collapse that you'd see. So and not only that, but they have investments. The bank, I mean, JP Morgan has a ton of commercial real estate that's probably worth almost zero. If they cause panic, what happens to the banks? What happens to JP Morgan? I mean, you have to look at the underbelly of why they would be sowing the seed of relaxation and no big deal. It's not as simple as like, oh, they truly believe that. It's more like there's these other factors that are making them say that. So just understand that. And by the way, it's not to say that the reduction in debt rating of the U.S. it's not a huge deal, but it's the beginning, in my opinion, of something that, again, should have been done a long time ago. The U.S., with as much debt as it has, should not be a AAA rated country. Jobs report tomorrow on Friday, so that's a big deal. I'm expecting between 100 and 200,000 jobs created. The ADP number was over 300,000, so it does show continued strength. Anything that's over 100,000 will probably be viewed as reasonably strong. Anything over 200,000 will be a risk of the Fed continuing to hike. Today we got some data here. Get some data out. Jobless claims today, guys, coming out at I think 227,000, which was right at consensus estimates. And basically what we do know about it is that continues to show that the jobs market in the U.S. is still pretty strong. ADP private sector yesterday, very strong as well. So the jobs number should be strong. The key is, what is consumer CPI? What is the CPI data next? I think it's next. I'm not sure if it's next week or the following week, but that is going to be the key. I think it's next week.
Argentina's economy minister, Sergio Massa, stated that the country will not use any of its reserves to repay the $2.7 billion owed to the International Monetary Fund this week. Instead, Argentina plans to cover the repayment through a swap agreement with China worth $1.7 billion and a $1 billion bridge loan from the Development Bank of Latin America. This move reflects an attempt to de-dollarize the economy, following other countries like Brazil, Bangladesh, and India, which have been exploring alternatives such as using Chinese yuan and Bitcoin for international trade and payments. Argentina has been facing a severe economic crisis, characterized by high inflation and dwindling central bank reserves. The nation's efforts to avoid a debt default with the IMF remain critical, and the recent measures are seen as part of the country's strategy to reduce reliance on the US dollar. Despite facing challenges and widespread rejection of the idea, experts suggest that fostering broader economic union in South America could promote much-needed economic growth. The outcome of Argentina's situation with the IMF remains uncertain, and any potential default could have significant implications for the country's financial stability and future economic prospects. For more Daily Dose crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.